Okay, let's unpack this. If your investment portfolio drops by like 50% today, the market does not owe you a 50% gain tomorrow to make you whole.
No, it really doesn't.
It actually owes you a 100% gain just to get back to square one, which, let that brutal reality sink in for a second. Today, we are taking a deep dive into excerpts from The Buffett Blueprint, Safeguarding Capital and Mastering Long-Term Value.
Yeah, and our mission today is to basically decode the investing philosophy of Warren Buffett. But we aren't looking at how he makes his billions.
Right.
We're looking at his obsessive, almost mathematical strategy for minimizing losses. That is really the engine of his entire methodology.
And he boils it all down to a deceptively simple two-part mandate. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Sounds pretty catchy.
It does. On the surface, that sounds like a bumper sticker. I mean, of course, nobody sets out to lose money.
Right, nobody wakes up wanting to lose their shirt.
But the source material notes something fascinating right out of the gate. Wall Street professionals find this rule incredibly hard to actually follow.
Oh, totally.
So if the advice is so obvious, why do the smartest guys in the room get it wrong so often? We're going to extract the practical wisdom behind this, understand the actual mechanics of a financial loss, and figure out how you, the person listening right now, can apply this defensive mindset to your own life, whether you're managing a 401k or just picking a few stocks.
And I think the crucial distinction to make right away is that never lose money is not like a literal magical guarantee that you will never see red numbers on your screen.
Right, because he takes losses.
He sees red numbers all the time.
Yeah.
Rule number 1 is a structural philosophy. It's a framework that forces you to prioritize the protection of your baseline capital over the temptation to just chase the daily, noisy, high-risk trends of the market.
Which makes sense. But before we even look at how he builds that defense, we really have to look at the why. Why is avoiding a loss so much more important than chasing a massive win?
Well, it isn't about ego.
No.
And it isn't about a desire to look invincible in the financial press.
Yeah.
It all comes back to that brutal math you mentioned at the top of the show, mathematical survival.
Yeah, the math of the ditch.
Exactly. What's fascinating here is how our brains naturally misunderstand percentages. Like, we are wired to think symmetrically, but percentages simply do not work that way.
So let's walk through the actual mechanics of it for everyone listening. The core math from the text illustrates this trap perfectly. Say you start with $100 and you lose 50%.
Okay.
You are now holding $50. If the market then turns around and goes up by 50%, your brain intuitively feels like, great, we recovered, we're back.
But you're not.
Yeah.
Because a 50% gain on your remaining $50 only gives you $25. You are now sitting at $75.
Wow. Yeah.
You are still down 25% from your original starting point, even though the market gave you what felt like a symmetrical gain. To actually recover, you need to double that $50. You need a full 100% gain just to get your initial $100 back.
And finding an investment that doubles in value is incredibly rare.
It's extremely difficult, yet you are forced to find one just to break even if you fall into that hole.
I was trying to visualize what this actually feels like, and it's like a video game where taking a hit doesn't just send you back to the start of the current level.
Oh, I like that analogy.
Right. Taking a hit permanently cuts your maximum health bar in half, which makes beating the next level literally twice as hard. You aren't just losing progress, you are destroying your actual capacity to make future progress.
That structural damage is exactly why Buffett uses a very specific analogy in the text. He likens financial losses to digging a ditch. The deeper you dig that hole, the steeper the walls become and the harder it is to climb back out to ground level.
Yeah, significant losses set you back years, not just in the money you lost, but in the time it takes to repair the damage.
Which brings us to the ultimate prize in all of this, compounding. The blueprint makes a very clear point that protecting your money isn't about playing scared.
You aren't supposed to hide your cash in a coffee can buried in the backyard.
Right, definitely not. The goal is to stay in the game long enough for compounding to actually happen. Compounding is simply the process where your investment gains start earning their own gains. It is exponential growth.
But compounding requires uninterrupted time.
Exactly. Every time you take a major loss, you reset that clock. You lose your momentum. Instead of your money working to build a skyscraper, all of your new financial energy has to be channeled into just filling in the ditch you dug.
And here is where the listener actually has a massive built-in advantage over the pros.
Oh, huge advantage.
The text points out that everyday investors possess a secret weapon that Wall Street portfolio managers absolutely do not have, and that's the luxury of time.
Yeah, the professionals are under immense constant pressure to meet quarterly and annual deadlines. They have to show aggressive results right now to keep their clients happy.
And to secure their bonuses, obviously.
And that pressure forces them to take risks. That risk leads to digging those deep ditches. You, listening to this, do not have a quarterly review with shareholders.
If we connect this to the bigger picture, time is the soil where compounding grows. Wall Street is basically forced to constantly dig up the seeds every 3 months to see if they are growing.
Which inevitably damages the roots.
Exactly. As an individual, you can keep your capital planted safely and just wait for the harvest. But, the operative word there is safely. The question becomes, how do you prevent your portfolio from falling into the ditch in the first place?
Well, since climbing out is mathematically punishing, Buffett has constructed essentially a fortress to protect his capital.
Yeah, the source outlines 6 pillars of defense. Let's look at how they actually function in the real world. The foundational layer of this fortress is simple, right? Invest only in what you understand.
Yeah, he demands absolute clarity on how a business makes its money before putting a single dollar in. The text notes he famously avoided technology companies for decades.
And that wasn't because he thought tech was a bad industry.
No, not at all. It was because the underlying mechanics of those businesses fell outside his personal circle of competence. He studies balance sheets, business models, and management teams intimately.
Like, down to the atomic level.
Pretty much. If he cannot clearly see how a company will generate cash 10 years from now, he just walks away, no matter how much hype surrounds the stock.
Which leads right into how he values the things he does understand. He prioritizes the quality of the business over a cheap price tag. The blueprint highlights one of his most iconic quotes for this.
It's a great one.
It's better to buy a wonderful company at a fair price than a fair company at a wonderful price.
And that is really the core evolution of his value investing strategy because, early in his career, he looked for what he called cigar butts.
Cigar butts.
Yeah, basically mediocre companies selling so cheaply that he could get, one last free puff of profit out of them.
Yeah.
But he realized that a fundamentally flawed company, even if you buy it for pennies, is a really dangerous place to leave your money long-term.
It's just a bad foundation.
Exactly. A wonderful company with a strong competitive advantage will generate immense wealth over decades, even if you pay a slight premium for it up front.
But let's say you find a wonderful company, you understand it completely, and you buy it. What happens if your math was just wrong? Or, what if a sudden economic shock hits the industry?
That is where the concept of a margin of safety comes in. It's his third pillar.
Okay, so how does that work?
A margin of safety is essentially building a shock absorber into your purchase price. So if you analyze a company and determine its intrinsic fundamental value is, say, $100 a share, you don't buy it at $98.
The gap is too narrow.
Right. If your calculations were off by even 5%, you are already losing money. Instead, you wait until the market panics and prices that same stock at $70.
So that $30 gap is your margin of safety.
Exactly. It protects you from your own misjudgments and from unpredictable market turbulence.
So if a margin of safety is the shock absorber, the text warns about something that acts like a financial explosive, which is leverage. The mandate here is to absolutely avoid debt.
Leverage is so dangerous. It's the practice of borrowing money to invest, hoping to basically multiply your gains. Let's say you invest $10,000 of your own money in a stock, and the stock drops by 50%. Right, you were down to $5,000. It hurts, but you are still alive.
Right, you're in the ditch, but you're breathing.
But if you use leverage, say you invest your $10,000, but you also borrow an additional $10,000 from your broker to buy $20,000 worth of that stock.
Oh boy.
Yeah, if the stock drops by 50% now, your position loses $10,000. That loss wipes out your personal equity completely. You are at zero.
And it gets worse. Right.
Much worse.
Right.
Because you still owe the broker the borrowed money, plus interest. Leverage doesn't just dig a ditch, it digs a grave. It accelerates your destruction if the market turns against you, taking you out of the game permanently.
Wow. Okay, so that brings us to the psychological pillars of his defense. You have to resist the crowd. You cannot chase trends.
Yeah, the blueprint notes that Buffett stays incredibly rational when markets become emotional. He refuses to buy into whatever the hot new thing is simply because everyone else is getting rich quick.
And the final piece of advice the text pulls out for everyday investors is to diversify. Spread your investments across different sectors to lower your risk, especially if you aren't a professional stock picker.
Yep.
Wait, I'm trying to square something here. Here's where it gets really interesting.
What's the contradiction?
Well, his first mandate is invest only in what you understand, right? He demands deep, intimate knowledge of a business's management and balance sheet. But then he tells the rest of us to diversify.
Right.
You cannot intimately know the inner workings of 500 different companies in an S&P index fund. If I'm holding a broadly diversified retirement account, I am inherently investing in hundreds of things I do not understand. Aren't those two ideas fundamentally fighting each other?
That is a brilliant point, and it is a nuance that frustrates a lot of people trying to emulate him. But the resolution really comes down to radical self-awareness.
Okay, how so?
Diversification is the shield for the amateur. If you are a listener with a full-time job, you cannot spend 40 hours a week studying corporate supply chains and reading annual reports.
Definitely not.
So your best defense against catastrophic permanent loss is spreading your bets through index funds.
You're basically admitting you don't have the map to the minefield.
Right. And because you lack the map, you don't put all your cargo in one truck. However, deep, concentrated understanding is the ideal strategy for a professional like Buffett. He doesn't need to diversify widely because his obsessive knowledge of a few specific companies serves as his margin of safety.
He has the map.
He built the map.
Yeah.
And the proof of his concentrated method is in the results. The blueprint notes that his longest-held, most heavily concentrated positions have generated his greatest wealth.
Like Coca-Cola.
Exactly. Berkshire Hathaway has held a massive stake in Coca-Cola since 1988 and American Express since the 1960s. That is decades of uninterrupted compounding in businesses he understands down to the atomic level.
But even with a perfect map, sometimes the ground shifts beneath your feet. Mistakes happen to everyone.
They absolutely do.
The text makes a point of highlighting that despite his nickname, the Oracle of Omaha, Buffett is notably honest about his failures. And I think the true test of this entire philosophy isn't just trying to build a fortress to avoid losses. It's about how you behave when the walls are breached and an investment actually goes wrong.
Yeah, the defense isn't about demanding perfection from yourself. It's about the speed and rationality of your response. When an investment sours, the text shows he admits it quickly, studies the failure, and takes action without letting his ego get in the way.
The blueprint lists some very specific, high-profile losses he has taken to prove this point. Airlines, Tesco supermarkets, and IBM. Let's look at the airlines. During the pandemic, he completely liquidated all of Berkshire Hathaway's stakes in the airline industry at a significant loss.
He also exited the UK grocery chain Tesco, publicly calling it a huge mistake after the industry's economics altered.
And he dumped IBM because its long-term prospects were simply less compelling than other places he could put his cash.
Right.
So what does this all mean for rule number 1?
Let's break it down.
If the golden rule is never lose money, isn't selling a massive stake in an airline or a grocery chain at a steep loss a literal violation of his own rule? Why take the financial hit? Why not just hold on to the stock and wait it out until the price recovers? Isn't selling at a loss exactly what he tells us to avoid?
It seems like it, right? But if we connect this to the bigger picture, we really have to differentiate between a temporary dip in a stock's price and a permanent loss of a business's fundamental ability to generate cash.
Okay, that makes sense.
The text specifically notes he sold Tesco because the, quote, industry's economics altered. The competitive landscape for groceries in the UK shifted so dramatically that Tesco's profit margins were permanently compressed.
So it wasn't just a bad quarter because of a temporary supply chain glitch. The actual machine that generates the wealth was permanently broken.
Exactly. And the same logic applied to the airlines during the pandemic. An airline is an incredibly capital-intensive business. They have planes costing hundreds of millions of dollars sitting on tarmacs doing nothing. But the maintenance and leasing debt still has to be serviced.
The meter is still running.
The meter is running fast. The fundamental structure of the industry was bleeding cash with no clear end in sight. When you hold on to a structurally broken company just because you are hoping the stock price will magically bounce back so you can break even, you're letting hope override math.
You're just sitting in the ditch hoping it stops raining.
Precisely.
Yeah.
Selling a broken company, even at a massive loss, actually protects your remaining capital from further destruction. It stops the bleeding.
Which is crucial.
And crucially, it frees up whatever cash you salvaged to be shifted into a better idea that can actually start compounding again. That aligns perfectly with rule number 1, protecting the capital you have left.
The text refers to this as his anti-gambler mindset. The classic gambler's trap is the sunk cost fallacy. Like, you lose a hand, so you double down on the next bet just to win your money back.
Yeah, and Buffett flatly refuses to double down out of pride. Humility keeps him flexible, preventing him from becoming emotionally attached to any single stock or narrative.
And that pivots us perfectly into the final major concept from the blueprint. Success in applying these rules relies entirely on the mind, not just the spreadsheet.
Buffett strongly argues that your temperament matters infinitely more than your IQ in investing. Because the math we've discussed isn't exactly quantum physics.
No, it's pretty basic math.
The difficulty lies in the execution. The ability to swiftly accept a loss, admit you were wrong, refuse to double down out of stubborn pride, and rationally pivot to a better idea requires a very specific, highly disciplined psychological makeup.
The golden rule of emotion here is to keep your feelings entirely divorced from your financial decisions. You have to actively resist reacting to fear or greed, which leads to arguably his second most famous quote, right behind rule number 1.
Oh, I know the one.
He advises investors to be fearful when others are greedy and greedy when others are fearful.
Which translates to staying reasonable and focused on long-term fundamental value when the mob around you is either panicking or speculating wildly. Like when the market plunges and everyone is selling out of terror, that is when the margin of safety appears. That is when things go on sale.
Right.
Conversely, when everyone is getting rich quick on a speculative bubble, that is when you need to be terrified of the impending drop. He accepts short-term market volatility as completely normal. It just doesn't faze him in the slightest.
It sounds like being the designated driver at a really wild party.
Yeah, that's good.
You have to stay completely sober and reasonable while everyone around you is either getting drunk on market hype, buying up whatever trendy stock is soaring to the moon, or they're panicking over a spilled drink and selling everything they own when the market dips by 2%.
Exactly.
You just have to sit there, sip your water, ignore the noise, and keep your eyes on the road home.
The drunk investors in that scenario are the ones taking on massive leverage to chase the party. They're the ones constantly digging ditches, taking hits to their health bar, and resetting their compounding clocks over and over again.
And the designated driver.
The designated driver is the one who actually makes it home safely with their capital intact simply because they accepted that a boring glass of water was the necessary price of admission for long-term survival.
So bringing it all together for you listening, the true wisdom of Buffett's blueprint isn't about having magical psychic stock-picking powers. It is about deeply respecting the brutal, unforgiving math of compounding.
Yeah, it's about recognizing the ditch of deep losses and refusing to pick up a shovel.
It's about building a defensive fortress, whether that's through intimately understanding a few wonderful companies or protecting yourself through broad index funds. It's about leaving your ego at the door when you inevitably make a mistake so you can stop the bleeding.
And above all, it is about letting time, which is your greatest advantage over Wall Street, do the heavy lifting for you. Rule number 1, never lose money, is ultimately a mandate to aggressively protect your long-term potential from short-term emotional mistakes. It forces you to survive today so you can compound tomorrow.
Which leaves me with this thought to mull over. If Buffett's entire empire and this entire philosophy is built on having the incredible patience that Wall Street lacks, how is the modern landscape going to alter that?
That's a great question.
We are looking at a world of constant, gamified, split-second trading on investment apps right on our phones. If every tap on a screen gives a user a burst of confetti and a dopamine hit, how might that fundamentally change the way the next generation even understands the concept of long-term value?
It's scary to think about.
How do you convince someone conditioned for instant feedback to hold a boring index fund for 30 years?
That is a profound tension between human psychology and modern technology. And, until we figure out how those forces reconcile, the best thing you can do for your own future is to remember the math. Protect your capacity to grow. Don't dig the ditch.
Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking for the bigger picture, and we will catch you next time.